Hello, everyone. Thank you so much for joining us here at CPA Academy. We are very excited to have David Kotler here. He is a national speaker, author, and entrepreneur who combines his legal and business experience to produce game-changing results for clients. And this session is Beyond Compliance, the Future of Consulting Services. I'm going to hand it over to David in just one moment. Before I do, we're going to do some housekeeping. We're going to make sure that everything is working just fine for you, the audience. Make sure you guys know about your handout, of course. Know how to ask questions during the session, and then let you know about your CPE. So let's start. The GoToWebinar control panel should be on the right side of your screen. You should see a little question chat panel area. If you wouldn't mind going there right now and say hello, let me know that the audio is working for you. You should see that first slide up on your screen. If you want to let me know what brings you here today, what interests you in this session, that'd be great as well. This is our audio check. Make sure everything's working. In the same area, there's also a handout we made available in your account at cpaacademy.org as well. And if you have questions during the session, this question panel is where you go to ask David any questions. We'll try and have time for a Q&A at the end, so please ask any and all questions. While you guys are typing right now, let's go talk about the CPE. This is a 1-hour course and is eligible for 1 CPE. In order to get that credit, you need to attend the session, minimum of 50 minutes, and then answer the polling questions. I'm going to help out and launch those polls. They'll pop up periodically during the session on your screen. You just select the radio button that best fits your answer and submit. We'll do our best to get that CP process a little bit later today, but you see it in your account by tomorrow. All right, look here. We've got Dwayne. Hey, Dwayne. We got New Jersey, Nebraska, Virginia, California. We got people from all over big class here today. Thank you. Everybody saying hello, and that looks good, and you can hear me, and well, that's all good to hear and see. So thank you so much, everyone. Looks like we were ready to go. I think we're good. So David, welcome. Thank you so much for being here. How about we have you flip on your webcam? You can say hello to the audience. Hey, David. Say hello to the audience. Perfect.
I'm certainly glad you could join us today. I'm looking forward to presenting this for you. And I'm here in lovely Cleveland, the prior home of the NBA champions. But our weather is pretty good, so we're looking forward to increased good weather and basketball.
Perfect. David, perfect. You're looking good. You can go ahead and go back to full screen mode on the session there, and I think we're good to go. Everything looks good. Thanks.
Okay, thanks, Nathan. So the title of this is Beyond Compliance: The Future of Consulting Services. This was a presentation that I gave as a panel discussion at an event called Winning is Everything, which is a very well attended meeting for CPAs, a lot of managing partners of CPA firms in Las Vegas every year. And it's really a great get together. And I enjoyed that experience. So I want to share some of that with you today. What I'm going to talk about today are the challenges facing CPA firms' growth due to the increased competition from outside entities, such as registered investment advisory firms, wealth management firms, law firms, and others, and the pressures which technology is forcing on the core offerings of CPA firms' primary revenues, namely tax preparation, traditional accounting services, and audits. As a matter of fact, there was a study done several years ago by the University of Oxford, and the study was to determine the probability or likelihood of certain types of businesses becoming obsolete due to technology. There were over 700 types of services that were ranked, and the number 1, 2, and 6 positions of those services most likely to become obsolete were, as I was just mentioning, tax preparation, traditional accounting services, and audits. But we'll discuss this a little bit later. I just feel this is why you may be interested in areas where the more proactive firms are expanding their consultative services to deliver to their clients what their clients actually would prefer, and how, through the process of adding more financial services, you can expand your revenue growth, you can retain and attract new clients, and you can be best positioned for the changes which are happening, whether you like them or not. But let me start with the backstory first. The year was 1972, not when that picture was taken. That picture was taken a little bit before that. But 1972 was the year that I graduated from Ohio State and wanted to embark on my lifelong dream of becoming an attorney. That's my dad in the picture, and he was the sole owner of a small food distribution business, which he had successfully maintained and kept in business. He bought out his mother, he bought out his siblings. But during the 22 years before I graduated law school, I saw very few days that it really seemed that he was enjoying his business. It was a very tough business. It was a small margin business. There were always disputes with the vendors. There were disputes with the customers, the banks. But he was very tenacious and he was very successful in maintaining that business. And we did about $500,000 of annual revenues. I did learn early the difference between getting your needs met and your wants met. And we had all our needs met. So that was good. So I said to him, I'm ready to go to law school. And he said, well, that's great, son. How are you getting there? And it dawned on me that I was going to have to work for him so I could put myself through law school at night. Training consisted of go get 'em. Fortunately, after about 5 or 6 years of knocking around, I found Haagen-Dazs ice cream. It became our bellwether product. I flew up to New York. I met Ruben Mattis, who was the creator or inventor of Haagen-Dazs. And it was a fantastic product for a number of reasons, which you can see on the screen. It was very innovative. This was really before there were any other super premium ice creams. And it was the type of product that is so good today that people tell each other about it. It was delighting the clients. It was very profitable for me because we had exclusive distribution rights for Northeastern Ohio. And although Haagen-Dazs wasn't widely sold back then, it became a product that once you put it on a grocer's shelf, it stayed there and they would expand the space because people would keep buying it. It was not a commodity. That was a key factor. So I didn't have to answer the question, how much are the price of eggs today? And you're dealing in pennies, but you can never make any money. This afforded good margins and they could be repeated over and over. So I was so enthused about Haagen-Dazs that we then got into Dove Bars. And Dove Bars was a great hit. Probably some of you still enjoy them today. And after Dove Bars, we got into Ben & Jerry's. Again, another fabulous product that was built by word of mouth. They started in a small garage in Vermont. After Ben & Jerry's, we got into Good Humor, which was owned by a multi-billion conglomerate, Unilever. But Good Humor was another fantastic product that had a great brand attached to it. Healthy Choice came next, another excellent product. So after having all these great products, I felt like I wanted to increase the volume of business that we were doing. And the only way to do that was to get a more mainstream product. The problem with the mainstream product is, unlike all these other products that I just showed you, it required slotting allowances, it required freestanding inserts, it required a lot of sampling. In other words, there were a lot of marketing costs. But as we took a look around the country to see what could possibly be successful, we came upon one product, which was Edy's ice cream. And we felt it had the panache and whatever to be sold through the system. But there were some unfortunate parts of Edy's which I didn't realize. When we analyzed whether it was a good product for us to add to our mix, I looked at it from a percentage basis. That's how I had been taught in the food distribution business, is what is your percentage of profit? What I wish that I would have had a closer relationship with my CPA at that point in time that might have said to me, well, David, percentages are okay, but let's take a real look at what the actual projected cost is going to be to you, considering you've now got these additional costs which you haven't had before, and what your actual profit is going to be on the product that you're going to be selling. If I would have been asked those questions it's very possible I would still be in the ice cream business. Because while we were very successful selling Edy's, we sold 1.5 million cases in the first 18 months. We actually lost $1 per case. And a business that had been in the family for 75 years was gone. So this leads me to ask a very important question of each of you. And that question is, do you have a close enough relationship with your business owners to prevent them from making a similar mistake? These are not life and death decisions, but they're huge decisions, and they're huge impacts on families that have businesses that can use your advice. As we talk later about all the competitive pressures that CPA firms are finding, whether it's through technology or whether it's through encroachment by other professional firms, I think that this question is really a critical question, which offers the opportunity for you to become more valuable and more irreplaceable to your clients. Nathan, did you want to do a poll?
Perfect. All right, everybody. We're going to launch our first poll. That should pop up on your screen right now. And it's which best describes the size of your CPA practice. And if you, there is the final answer. If you're not a CPA practice, if you wouldn't mind just writing in the chat after you select that, what kind of a firm or company do you work at? And leave this up for about 30 more seconds. Perfect. Looks like majority are saying 1 to 3 partners, but then we see here, well, we got people Walt Disney Company, nursing home management, insurance management company, healthcare. Perfect. All right. Thanks so much, everybody. We're going to close that poll. Like I said, majority of the audience said 1 to 3 partners. David, back to you.
Oh. So I did get some good advice from my CPA after we lost our business. And he suggested to me, why don't I go into the financial service business? I had a law degree. I had an interest in trying to increase philanthropy. I had a pretty good Rolodex. And I thought that those might be good ingredients, and he felt they could be good ingredients in the financial service arena. And as I got into that business, I kept asking myself, you know, what is the parallel product or service like Haagen-Dazs? What is it that can really provide tangible benefits for clients? And it took quite a while to figure this out, but it really was after a relationship that I developed with an attorney that gave me the name, like the life insurance doctor, because I review the health of policies that are already in existence. That became my mantra and my way to add value and tangible benefits, cash savings, but doing it as a trusted advisor, providing a service, not going out to try to sell something. And so this has been my career, and over the last 3 or 4 years, I'd like to share some case studies that I've recently completed. Larry is a CPA. He was working for a CPA firm that I had a business relationship with. And when he learned what I did, he says, you know, I've never really had my policies reviewed. I think I'd like to have you review my policies. And as a result, we took a look. He had 4 policies totaling about $4 million of death benefit in total. 2 of those policies had been purchased some time ago, and they were whole life policies that endowed at age 90. When a policy endows, that means if the insured is alive, the cash surrender value inside the policy will be returned to the owner of the policy. They will not get the difference between the cash and the death benefit. There's one other very bad impact if your policy endows while you're alive, is that if there is any gain over and above your basis, that is going to be taxable. He also had two other individual, what we call underfunded universal life policies. One was a conventional policy, and the other policy was a variable policy, which are very risky because those types of policies do not offer any downside protection. If the market goes down 30%, your cash account inside the insurance policy goes down 30% as well. So those are really not a recommended product at any time. In reviewing the policies, we knew that we had to convert the whole life to policies which would have a guarantee or likelihood that they would last way past his life expectancy to age 120. We were able to convert the risky variable policy to a more traditional universal life policy. So we extended the coverage on the whole life policies. We avoided the policy lapses on the underfunded policies. And we took the existing cash from his policies and were able to transfer it into the new policies tax-free. It's what's known as a 1035 tax-free exchange. So the bottom line results were Larry saved $55,000 annually on the 4 policies that he ended up with versus what he had. We got rid of that potentially very bad result with the policies which endowed at age 90 and extended the death benefit out to 120. And really, we also were able to make the portfolio in total more conservative. Here's another case. Henry is 85 years old, very wealthy gentleman, a widower. He had a net worth of approximately $50 million, but he had income, estate, and gift tax issues. He owned a lot of insurance, but nobody was really guiding him as to how to pay those premiums for which policies. And as a result, some of those policies were overfunded and some of those policies were underfunded. He also had some income tax issues because one of the policies was purchased as a modified endowment contract, which means that any money that he would ever want to take out of that policy would be taken out and it would be taxable. In reviewing all his policies, what we're able to do was to extend coverage on 8 out of the $25 million worth of coverage without spending a penny more. All we did was juggle the monies that were being paid and put more money on the policies that needed it and less on the ones that didn't. We also found an extra $2 million in one of those policies that really wasn't necessary to keep the policy going. And we were able to deploy that money in a better manner for Henry. He had another policy, a $10 million policy that was calling for over $400,000 in annual premiums that he really didn't want to pay that much in the premiums. And due to his age, we were able to find a buyer in the life settlement market that was willing to pay all the premiums going forward and allow Henry's trust to retain $6.5 million worth of the death benefits, which of course would be paid income tax and estate tax free to his heirs because it was the trust that remained the beneficiary, which was already set up outside of his estate. Henry had a smile on his face like you see on the screen. This was a very interesting case. This was some long-term clients that I've had for many years. They have a very successful manufacturing and food distribution business, and a business that did well over $100 million in revenues on an annual basis. But like almost all businesses, it had its ups and downs. And unfortunately, it had gone through a 2 or 3 year downturn, and they were not showing a profit, and the banks were getting nervous. Well, the two brothers, who were the primary owners of the company, had 2 large life insurance policies that were funded by a split dollar agreement. What that simply means is the company was lending money to the trust, which owned the policies, and the company would be paid back those loans at the demise of each of the owners. Well, those loans totaled about $4 million to this point from the company, and there were ongoing premiums of an additional $400,000 per year. The bank said they didn't want any more premiums paid for something that they did not consider to be critical to the running of the business. If the split dollar agreements were to be ripped up, what that would mean is that all those loans, the $4 million worth of loans from the company to the owners, which the owners would not be able to pay back, would be considered forgiveness of debt, and that would be considered ordinary income, creating a $2 million tax detriment for the owners. Not a good result. In addition, if the company had to write off $4 million from their statement, the fact that they weren't that bankable now would really make them not bankable. So it was really a bad situation that we really had to look for a solution for this. So what we considered was, if we terminate the contracts, we know we have all those bad tax results. And we felt the same if we sold the contracts, that we would have bad tax results. But by creating a deal like we did with Henry, where we found a buyer to agree to take on all the future premiums, and in return was willing to leave a portion of that death benefit for the trust, that allowed us to keep the split dollar contracts in place. And because they were kept in place, we were able to miss out on a lot of the bad effects that we would have had the contracts been ripped up. Number one, we satisfied the bank, which was really important. We didn't have to pay any more premiums from the company. We didn't have to write off the $4 million for the employer, so they remained bankable. We saved $2 million worth of income tax for the owners. We were able to keep some small portion of the death benefit that had been purchased as a benefit for the owners' families. And the icing on the cake was we were able to get about $350,000 for each owner out of the policy before we sold the policies. That's why you see him smiling in the picture as well. So I'd like to shift gears for a second and talk about a program that I have, a outside resource that I work with, and it's called Intelligent Leverage Using Life Insurance. This became an industry disruptor in the life insurance business about 20 years ago. It was brand new at that point. As a result, over $40 billion of life insurance have been financed over the last 20 years using other people's money. This is the intelligent leverage I'm talking about, is borrowing money from high-profile banks that are willing to lend using the policies for collateral for about 90% of the loans. And what it does is it discounts the cost of life insurance. I think we all know that one of the major problems for business owners is having sufficient cash flow. And when they need insurance or a lot of insurance, if there's some way that we can discount the cost of that life insurance and they can turn around and keep those very needed dollars back into their business, it becomes very attractive to them. Because you're spending much less money, and bear in mind that intelligent leverage is really for the high net worth client. Clients that have a net worth of less than $10 million are probably not going to qualify for this. It would not be an appropriate program for them. But if they have that type of net worth and they have that type of need and they're spending well over $100,000 a year in annual insurance premiums, it becomes a very, very valuable process. And it's custom designed to meet estate and business objectives. Let me show you a case and how it actually works and where the discounts come in. The name of my resource is Succession Capital Alliance. They are and have been the industry disruptor, the only company which is co-branded with the major insurance carriers and able to secure the very best finance rates from name brand, national brand banks. So here we have a 50-year-old couple. They're very healthy and they want to buy a $10 million life insurance policy. The cost of that policy is $63,000 and change, as you can see on the upper left. And the internal rate of return at life expectancy, because the joint life expectancy on a pair of healthy 50-year-olds is 37 years more, age 87, would be close to a 7% return, IRR, on the $10 million of benefit, of course, delivered income tax free and estate tax free. It's a good deal, but here's an even better one. By using the bank's money, you can see the savings are close to $1.2 million, or in the cash flow discount column, 62% of the total money spent. And therefore, the internal rate of return is increased all the way up to close to 10%. What we did to figure the retained capital was that the dollars that were saved were assumed to go into a retained capital account, assuming a very modest 4% growth rate over the 37 years, grow to close to 2.6 million, so that really your combined net benefit is close to $13 million by using this program. Just want to share a success story. One of my associates, CPA associates, very recently learned about this program. And he was very enthused, and he had a lot of clients that fit the profile. And he got about 30 of his clients into a room for a presentation. And as a result, 12 of those clients are moving forward, buying insurance, utilizing this type of program. If you talk about what CPA firms can do, especially ones that I believe have a high net worth practice, or perhaps even have a lot of high earning doctors, there are other programs which are very sophisticated, which I don't have slides on, but I'll just mention in passing. There's a captive insurance program, which has it's very conservatively done, but it has a very unique feature that it's able to incorporate healthcare costs for companies with large amounts of employees, where there's a lot of opportunity to save money with little or no risk. There's also a program to help high earning doctors be able to put much more money aside for themselves on a tax advantaged basis, which is a special program another resource that I can bring to the table. But let's go back to what we were talking about earlier, life settlements. I think almost everybody can relate a life settlement because it's very similar to a reverse mortgage. There's no health exam necessary. The value of the policy which is being sold is dependent on how old the client is, depends on what the current premium to keep that policy in force till way past his life expectancy is compared to the death benefit. And then there's what we call a life expectancy report. All these combine to generate an appraised value. If the policy is in the money, instead of making policy payments, the client is either going to receive cash or he's going to receive a retained death benefit or some combination of both of those. So with today's tax laws changing and today's estate tax amounts that you can transfer tax-free, many of your clients have policies that they don't need anymore. The purpose for which they purchased them doesn't exist. And having life insurance that you don't need is like betting on a losing poker hand. I have to share that my son is a professional poker player, so I wanted to have one slide for him as well. But it's a true adage. If the clients don't have the need for it, then what's the point of holding it? Just the trick is to finding out what's the best thing to do with it. There are 266 million life insurance policies in force today. But here is a shocking statistic. 90% of all those policies do not last until maturity. And this is a secret that life insurance companies really don't want you to know, and which has prompted me to write a book on that topic. But when you think about the fact that so many people buy policies and spend money on them year after year and end up with no return, it's like throwing money down the drain. It's really a bad result. So what can we do? Let's take a look. How can we find the money? And let me invite each of you to please, if you can, at some point, not now, go to my website, lifeinsurancedoctor.com, and look at the Find the Money page. I think you'll find some interesting ideas there on how we can help your clients find the money. The average amount that a client is going to receive via a life settlement, as opposed to surrendering the policy to the carrier which issued it, is somewhere between 600 to 800%. It's not quite the dramatic difference you see here, but it's about 6 to 8 times as much money by settling the policy versus just turning it in to the insurance carrier. Life settlement is a very well settled business. If you take a look at the map, you see very few states that are not regulated. The states that aren't regulated doesn't mean that settlements can't go on there, but I believe what it means is that the government recognizes what a consumer-friendly process this is, and they want them to have the certainty and the safety and the confidence that these are a good process to go through. I mentioned Gail Crosley earlier. I met her again through the Winning is Everything conference. She is, I think, one of the best known consultants in the CPA industry. And when she made this statement to me, I didn't understand exactly what she meant, but over time it became much clearer to me. The railroads didn't realize that they were in the transportation business. Had they realized that, maybe they would not have been asleep at the switch when other forms of transportation became so popular, whether it was automobiles or airplanes. They just didn't realize they were in the transportation business. They too narrowly defined their business. So we spoke earlier about the University of Oxford study. And here is a chart depicting the results of that. What they're saying, what the University of Oxford study shows is that the tax preparer has a 99% probability of having his job lost through automation. The accountant, 98% certainty. And the auditor, 94% certainty. This is out of over 700 professions. The profession that had the least likelihood of becoming automated was, it makes sense, a recreational therapist. But I think this shows the danger or the forces that are happening with technology and why it's really incumbent upon CPA firms to start looking for ways that they can not so narrowly define their business, but really give the clients what they need and what they want. Because those three, according to the data, represent 80 to 90% of current CPA's revenues. Nathan, I think we're going to do another poll at this point.
Sure. I think, is this, should we do this one on the offering types of financial consulting, I think?
Yeah.
That sounds right. All right, everybody, we're launching poll number 2. Are you currently offering any type of financial consulting like wealth management? If so, what do you offer? We'll leave this up for about 30 seconds. All right. And I know a lot of our audience did other, but then we also had the second one would be estate planning and then also wealth management. All right, we're going to close that poll. And David, back to you.
Okay, thanks, Nathan. So I think the bottom line after looking at those slides are you defining your scope of services too narrowly? Let's get into some data that we've seen recently from the AICPA. This data was shared at last fall's meeting, the council meeting. So it's certainly on their agenda. And although you see the difference between 2013 and 2015, I don't have the data, or it wasn't supplied through 2017, but I'm sure that that 20% number continues to increase. And this reflects the dramatic expansion investment firms are doing, which is cutting into CPA firms' practices. A lot of surveys have been done, and these are the results of what your clients want. They want what's known as integrative services. They want a one-stop shop for financial advice. And who in the world could be better positioned to provide that than a CPA? You have a more frequent relationship than their attorneys. You are probably their most highly trusted professional that they deal with, and they need you for more services. If you look at the 5 areas that are comprising integrative services: retirement, tax, estate planning, education, and charitable, it's so much more beneficial when a client can get these in one place. And interestingly, insurance directly affects 4 out of those 5 areas. There's a distinct connection with all 4 of those areas. So now I believe you have another poll you were going to do now, right, Nathan?
All right, we're going to launch our 3rd poll. And that should be popping up on our audience screen right now. And when it comes to using integrative services and collaborating with outside resources, what are your biggest concerns? If you have other, you can, of course, type that into the chat to give us more details. We'll leave this up for about 30 seconds. All right, we're over 90%. Let's see here. We got some people doing other. The majority are saying not my expertise is their main concern. Also being perceived as a salesperson. People typing it as well as vetting the resources, failure for referral to deliver. Good answers there. All right, David. So I think that we've gone over 95%. So I'm going to close that poll.
I believe you were going to take over the screen.
Yeah, and we're going to share that screen. You can walk us through that now. So let's close. And let's there you go.
So I wanted to share a few testimonials, video testimonials from a CPA and an attorney that I've been working with.
My name is Larry Horwich, and I'm an accountant in Chicago, Illinois. And I came across a client who had a 15-year term policy who was in the end of her 15 years of term, and there was a conversion feature. However, there was only a few months left before she had to exercise that conversion option, or the insurance policy would lapse. And David, I had contacted several of the brokers here in Chicago that we had used, and none of them could find a buyer for this policy. I contacted David, and he said, let me give it a try. And he went to his network, and he located a buyer for this policy to the point where the client was absolutely thrilled. He took care of all the paperwork. His team was exceptional, and they consummated a transaction that nobody in the Chicago market could do. In fact, the client was so satisfied that she and her husband referred one of their neighbors in California to David, who consummated another transaction shortly thereafter. So if you're looking for somebody that can think outside the box and has a tremendous network of clientele to rely upon for transactions for your clients, David is an excellent choice. Thank you.
All right, and David, should we launch go into the next one?
Yes, sir. Thank you.
Hi, my name is Rodney Piercy. I'm a legacy strategist and estate planning attorney in Barrington, Illinois. And I've been working with David Fowler now for about 2.5 years. And we have really done some great things for clients. A year and a half ago, we rescued several very, very large policies which were in deep trouble. And while we were at it, we were well paid. I personally made about $400,000 on these transactions. The client was absolutely delighted because he had policies that were going to crash and burn, and now he has replaced them with great policies. I thought of David as someone who actually can look at an insurance policy and tell me the health of it. As you know, an insurance policy is an asset and needs to be managed. And so I called David the insurance doctor, and my clients love that name.
Let's see here.
Perfect. All right. So David, should we I guess we'll launch one more poll and then we'll go back to you.
Yes, sir.
Or yeah, here we go. And this is our fourth poll, everyone. And actually, you know what? Maybe you should chat a little bit more and we'll launch that last poll in just a few seconds. You can chat a little bit about that.
Okay, great. Thanks, Nathan.
Let me make you
So-
presenter again, David, so you can share your screen.
Jeremy.
Perfect. There we go. We're seeing your screen now. Thank you.
Okay, great. So what are the benefits of providing this type of service for your clients? Well, new revenue streams, increased client service and satisfaction, as I think you've seen from the testimonials, new referrals. And over the past year, I've delivered over $15 million of cash and cash savings to clients. I've paid out over $1.3 million in referral fees. And I don't mention these numbers to impress you, but rather to impress upon you the need that your clients have for these types of services, and that they have to have their policies reviewed every 2 years. It's just too critically important to let it go. But you may be saying to yourself, you may be thinking about one of these, what I call the 7 myths that CPAs believe about life insurance. Number 1, if I refer the work out, I could lose a client. And we see from the poll that about 10% of you answered that that was your concern and maybe why you're not utilizing life insurance. I hope that you've seen from the way we operate and what we provide that we never are trying to make a sale or force somebody to do something. We try to educate the client and act as a consultant to bring clarity and to bring solutions if they have problems. There's not problems 100% of the time. It's probably closer to 65 or 70% of the time. But we do usually solve the problems if they exist. And the converse becomes true. Instead of losing clients, you'll actually gain clients about half the time we do work, because people are getting that tangible benefit, cash or cash savings, that makes them happy and makes them want to share that story with their friends or their relatives or their associates. So that's the number 1 myth. What's the second myth? Being perceived as a salesperson. The second biggest answer in the poll as to why you don't want to do it. Well, I don't want to be perceived as a salesperson either, to be honest with you. I want to be perceived as somebody that is adding value, that is bringing accurate, clear information in an area that really screams for it, and not trying to sell anything. I'm very sensitive to being sold, so I don't like to try to do it to others. So I think that the way it's approached, and of course, if you outsource, resource it, you're not the person making the presentation, you're facilitating a relationship, which hopefully is adding a lot of value for your clients. What's the third myth? I'm a CPA and I'm already doing wealth management. Well, if you're doing wealth management, and I can tell you that that was the very strong message at the panel discussion I was at Winning is Everything, is that far more firms are doing wealth management, but not doing life insurance. And wealth management is a relatively easier entree to get into. But because of what we've discussed about integrative services and what they want, if you're doing wealth management, it really would be a logical progression to add life insurance reviews and audits to your practice. My clients are getting this elsewhere. This myth should really be destroyed when we understand a couple of the dynamics that are going on. 70% of the policies that are in existence today were sold by people, agents, that are no longer in the business. So of the 30% of agents that are still in the business, and there's a lot of fine agents, but the compensation system for life insurance gives the vast majority or all the compensation to the agent up front. And it's really not a good system because it doesn't provide the revenue. The agents still should be servicing these clients, but a lot of, people have to make a living, and I'm not making a reason why or an excuse. The point is your clients are not getting it elsewhere, and they need this service. I'll share a couple things that I've seen recently. There was a TV show a couple years ago on 60 Minutes, and it was a big expose, and it was about the life insurance industry's practice where carriers that had issued both annuities and life insurance policies were very carefully keeping track of how long their clients were alive. Why? Because they didn't want to pay 1 month worth of an annuity after the person had passed away, right? Well, a lot of those annuity clients were also life insurance clients. So they had the records of people that had both annuities and life insurance. The problem was they would proactively cut you off if there was an annuity, but if there was a life insurance policy and there was no claim made, they would not notify the family or the owners of those policies. It ethically wasn't right. It financially wasn't right. It resulted in a $7 billion settlement. Some of the carriers are still fighting it. Many of them are paying it. The point is that we're talking about an area where your clients need an advocate, and they are not getting this advocacy today. They need this service. Well, there's not much benefit for me or my clients. Well, I think we spoke a little bit about the kind of tangible benefits that we're providing for clients and the kind of tangible referral fees which are being generated for firms. So I think that myth should be not a good one. It will take too much time. This is a real concern. I am very sensitive and understand the time constraints of a CPA, especially perhaps in a firm that doesn't have, is not a very large firm. And that's why our program is pretty much a turnkey program. It is designed to take the brunt of the effort off the CPA's desk and put it on my desk, because I know it would take too much time if you got involved. Some CPAs are still involved, of course, from the tax aspects of whatever deal is done and consulting if it's an estate planning type situation. But the fact that it'll take too much time has been very much taken into consideration. Lastly, I talked to some firms, I work with a number of firms that have some type of insurance program, but they don't even have a basic record-keeping system to incentivize partners to bring in new referrals. And they think, well, maybe they don't need it. We're all working for the same thing. But everybody has a limited amount of time during the day that they can put into what's best for their clients and for themselves. And if they're not even really being financially recognized for bringing in new business, they're not going to bring in new business. It's just the contingencies of the day. So a question for discussion is, could it be that getting involved with your client's life insurance is an opportunity to service them and help yourself? And I think this is a good point, Nathan, to do the last poll.
Perfect. All right, we're launching that now. Would you be interested in knowing more about how life insurance can be an integrated service for your client base? And we'll leave this up for about 30 seconds, and then we'll go over any questions that may be from our audience. All right, we're over 90%, so we'll be closing that in just a second. Let's see here. There is a question. It says, what licensing requirements would I have to receive referral fees, both insurance and investment wealth management? I don't know if you see that in there, David.
Great question. Ordinarily, you would need to have somebody in your firm get licensed. What a lot of firms do is they set up a separate LLC and they have one of the partners is all that's necessary, because that way the proceeds can be shared. And the best way to do it is to both get licensed for wealth management and licensed for insurance. As it so happens, if you're only doing a settlement, CPAs and attorneys do not have to be licensed for that.
Perfect.
Any other questions, Nathan?
I think that is about it for now. And then anything I don't see in here, we will be sending a full report over to David a little bit later today. So David, I don't know if you have a final slide you want to put up, but thank you so much for being here today. Really appreciate it.
I think just a final comment, Nathan. Please feel free, any of you that are somewhat interested or interested in learning more, to reach out, give me a phone call, send me an email. And if you do, I'll send you an article that I wrote regarding the 7 most common mistakes found in your client's life insurance policies that might surprise you and might even apply to your own policies. So I thank you, Nathan, and I thank everybody for attending, and appreciate having the opportunity to talk to you today.
David, thank you so much. LifeInsuranceDoctor.com. I just sent over David's email to the audience, so that should be in your chat if you'd like to reach out directly. But David, thank you so much.
Thank you, Nathan. Have a great day.
To our audience, thank you so much for attending. This is a 1-hour course, 1 CPE. We'll do our best to get the CPE process a little bit later today. We also recorded the session. We'll make that recording link available to you in the post-webinar email. Thanks so much, everyone, and hope to see you at future webinars.